Good morning and welcome back to Margin. This morning we're going to talk about how much you should spend on housing making $48,000 a year. So let's jump right into it. So looking at the home mortgage products available to you today against the income that you have to spend on a mortgage, it's important to seriously look at what you can actually afford based on estimated household incomes. Now, it's easy to get caught up in what you qualify for from a bank or financial institution, but not actually realize that although they do benefit by you actually paying your mortgage, they also benefit from you signing on for a larger loan, a larger mortgage, producing larger amounts of interest that goes directly into their pockets. So with household incomes relatively stagnant, let's look at 3 scenarios over the next few days based on a hypothetical income and what you should then be attributing in regards to a portion of that income to a home as a means of figuring out what you should be spending. So let's say that you are a single 24-year-old college graduate in your first or second year of your new career, making an income of $48,400 per year gross. So let's say that you're in a tax bracket of 22%, contributing a minimum of 3% toward a match for your company, toward retirement, and you are opting in for one exemption. So I say all of this because it factors into what your net take-home pay will look like. So this gross income would put you at about $4,033 per month. Now, with that is your gross income. So you need to factor in that you're not going to see all of that. Now, you're going to have federal and state taxes, and you're going to have other components that come out of that give you your take-home pay or what actually hits your bank account. Now, using a paycheck calculator, this will help you to figure out, okay, what are you anticipating to receive from that paycheck after everything is said and done. So based on that gross income, you can anticipate having it reduced by about $552 for taxes. Then an additional $309 for FICA and state insurance taxes, as well as pre-tax deductions of $121 and post-tax deductions of $500 for benefit contributions and retirement savings. Now this, at the end of the day, leaves you with a net take-home pay of $2,552 per month. Now this means that you will have that $2,552 to put towards housing, additional retirement savings, giving, debt, and your lifestyle otherwise. Now this is about 63% of your gross income that you actually get to keep after those things are covered and after those things are paid for. Now, the elephant in the room is the mortgage or rent cost, as they are typically the largest single expense within any household. Now, the advice for what this figure should be is all over the place. Business Insider referred to Americans spending nearly 37% on housing, but a percentage of 38% is typically what the maximum amount a bank or lending institution will approve for a mortgage loan based on your financial situation. Of course, it may be different based on your debt and everything else. Now, there's been a rule of thumb of 30% of your gross income going to housing. And now this has been in place for many years, but there are also those who recommend 25% of gross income, or maybe even those who follow Dave Ramsey's principles and put 25% of your post-tax income towards housing. So whatever scenario you use, you just need to figure out, okay, what is that number that is actually comfortable for you, and be able to run with that so that you are not spreading yourself too thin. So in this first scenario, let's look at 30% of your take-home pay sitting at about $765.60 per month. If you're like me, you're thinking immediately, that's a huge sucker punch. And at least in my area, I don't know what neighborhood that would put you in for a purchase or much less a rental. So if you are feeling the pinch of trying to be intentional with your finances, but seeing scenarios where you almost always need to spend beyond the recommended parameters, then what do you do? How do you handle that? So in this scenario with the recent grad, I would recommend finding a solution to either house hack where the initial percentage of income is higher, but then reduced based on renting out rooms. And I believe that this is an ideal scenario for this case in particular. So if purchasing is just out of the question right now, then finding a place where you can split up the rent would be the next best option. So if roommates are not an option at all, then I would recommend working to increase your income, whether through promotion, moving companies, doing a side hustle, or something otherwise to shorten the distance to being able to purchase a property on your own. So let's jump ahead and look at what a purchase scenario with a house hack would actually look like in this scenario. So assuming you have a standard 3-bedroom, 2-bath, single family home that you purchased for $215,000, let's use some easy math and let's assume that you went the route of getting a conventional mortgage where you put 20% down. Now, after you have principal, interest, estimated taxes, as well as any homeowner's insurance and HOA fees and so on and so forth, let's say that the mortgage is $963 per month. Now, although this would stretch you to some extent from your $765 amount that we looked at, if you actually rented out each of the additional 2 bedrooms to, let's say, 2 friends at $500 per room, and you split up utilities, you would essentially live for free. So my call to action today is to look at this scenario and how it may relate to yours. You know, whether you can house hack, whether you are house hacking, or whether you have an option of changing your home altogether in order to change that percentage of your take-home pay that you're actually spending on housing. Really consider what changes need to happen so that you are able to live more freely and you're able to breathe a little bit more with how much you're paying for housing. If this information is helpful to you, please do like, subscribe, and hit the notification bell so you're reminded to come back on a daily basis and improve in managing your personal finances. Thank you for your time. Enjoy your day, and we'll see you back here tomorrow.